All right, welcome to the Explainer. Today we're going to tackle a really interesting and pretty complex investment product. It's the NEOS boosted S&P 500 High Income ETF, ticker XSPI. It makes some pretty big promises, so let's break down exactly how it's supposed to work. So right off the bat, here's the big question that probably jumped into your head. How on earth can a fund tied to the S&P 500 aim for 1.5 times the exposure and shoot for a double-digit yield? That's way, way higher than the index itself. It sounds a little like magic. So let's pull back the curtain and see what's really going on.
To figure out the how, we gotta start with the why. This right here, this is the fund's official goal straight out of the prospectus. And you can see it really boils down to 3 key things: high monthly income, trying to be tax efficient, and of course, grabbing some of those stock market gains. Just keep these 3 goals in your head as we go through this.
Okay, to really get our heads around this thing, we're going to peel it back layer by layer, kind of like an onion. And lucky for us, the very first layer, the core of the whole thing, starts with a foundation that should look pretty familiar.
So if you boil it all down, the fund is doing 2 main things at its core. First, it actually holds a big basket of stocks that make up the S&P 500. Simple enough, right? Just like a regular index fund. But that second part is where it starts to get interesting and where the income engine really starts to rev up. It sells or writes call options on the index.
Think of selling call options like this. It's a great analogy. It's like you're renting out the potential upside of the stocks you already own. In exchange for that rent, which is called a premium, you get cash in your pocket right away. That's a huge part of how this fund generates that high income. But there's always a trade-off, right? And the trade-off here is you're capping some of your potential gains if the market really takes off.
But just holding stocks and selling some options? That's just part 1 of the story. The next layer is where the fund gets that boosted part of its name. This isn't just about holding stocks. They're adding another, much more complex layer of exposure on top of it all.
So instead of going out and buying more physical stocks, which would cost a lot of money, the fund uses derivatives to create something called synthetic exposure. On one hand, you've got physical ownership. That's easy, right? You just own the shares. But synthetic exposure, that's different. It's about using options to mimic the financial result of owning stocks, but without having to shell out all the cash to actually buy them.
So how do they actually do that? How do you create this synthetic position? Well, it's a pretty clever combo of options. First, they buy call options on the S&P 500. That's to capture the market's upside. Then, to get more income and complete the picture, they sell put options. Now, selling a put means they get paid a premium, but they agree to buy the index if it drops to a certain price. When you put those 2 moves together, well, the financial outcome starts to look an awful lot like just holding the index itself.
And that is how they get to this number. This is the whole point of the boosted strategy. They take the physical stocks they own, they add on that extra synthetic exposure from the options, and the goal is to get a total investment exposure of around 150% of the S&P 500.
Okay, so you might be asking yourself, why go through all this trouble? Why all the complexity? Well, it's all in service of those other 2 goals we saw way back at the beginning. Chasing that high income and trying to do it in a tax-efficient way. And that first big target is the income. Just look at the difference here. A regular S&P 500 fund might get you a dividend yield of 1.5%? XSPI, on the other hand, has an aspirational goal, and I really got to stress that word, aspirational, of distributing between 15 and 18% a year. Now, the fund is super clear this is just a target, it is not guaranteed at all, but let's be honest, it's the main reason someone would be looking at this fund in the first place.
The second big goal is tax efficiency. And the way the fund tries to get there is by using a very specific part of the U.S. tax code. See, the special index options it trades, these SPX options, they qualify as something called Section 1256 contracts. And here's why that's a big deal. The IRS gives these specific contracts special treatment. No matter how long the fund held the option, even if it was just for a day, any gains are automatically treated as 60% long-term, which gets a lower tax rate, and only 40% short-term. For an investor in a taxable account, that could lead to a much, much smaller tax bill.
Okay, let's pause for a second, because this is, without a doubt, the most important part of this whole explainer. You just don't get this level of complexity and this kind of potential reward without taking on some pretty significant risks. So let's look at what the fund itself tells you to watch out for.
First up, and this is a big one, is leverage risk. Remember that 150% exposure we were just talking about? Well, that is a classic double-edged sword. Sure, it can juice your returns in a rising market, but it's going to do the exact same thing to your losses when the market falls.
A small dip in the S&P 500 could mean a much, much bigger drop in the fund's value.
And then there's the risk that comes with the options themselves. The prospectus says it pretty plainly. The potential loss from selling options could be unlimited. Now, obviously, the fund has strategies to try and manage that risk, but it's just a fundamental built-in risk of the very tools they're using to generate all that income and extra exposure.
And this next part, this is a direct quote from the fund's own documents, and you really need to let this sink in. It says that just because you get a check from the fund, a distribution, don't assume it's a profit. It could just be the fund handing you back a piece of your own original investment. That's something called a return of capital.
And the list doesn't stop there. You've got active management risk. You're basically betting on the manager to make the right calls. It's also technically non-diversified. It's a pretty new fund, so it doesn't have a long track record. And, like we already talked about, the covered call part of the strategy means you will miss out on some of the upside if the market goes on a huge tear.
So we end up right here with the one question every single potential investor has to ask themselves. We've seen how this ETF uses a really complex engine of stocks and options and leverage to chase after some seriously high tax-efficient income. But we've also seen the very real and very significant risks that come right along with it. In the end, it all comes down to you and whether that specific trade-off is something that fits with your own financial goals and, just as importantly, your stomach for risk.